So, AB Limited acquired a car business at the start of the year for $230,000, when the net asset of the car business was $190,000 as follows. Now listen carefully. AB Limited acquired a car business at the start of the year for $230,000, when the net asset of the car business was $190,000. Into off the bet before I continue. I said if you pay more than the net asset of the company, the difference is treated as what? Goodwill. So there is a goodwill that we have to recognize here. And 230 minus 190, what is it? 40. So the net asset of the company as follows: garage 20, computers 10, vehicles 90, tangibles 30, receivables 10, cash 50, payables 20, and the net asset is 190. Additional information: on the 1st February, the car business had 3 vehicles stolen. The net selling value of each asset was $10,000. Because of non-disclosure of certain risks to the insurance company, the vehicles were uninsured. What does it mean? What does it mean? If we say some vehicles were stolen, they were uninsured, what does it? How do we treat that? Is that an impairment? Is it a loss? Because the total vehicles of the company is 90. Now, 3 of them, which is 30,000, has been stolen, and so we didn't insure also. So does it mean the value of our vehicles has reduced, or the value of our vehicle is still the same? It has reduced. Are you getting the idea? Because we didn't insure. If we insured and insurance is paying for it, then it would have been the same thing. So this is called separately identified asset. Remember the allocation I said. The first thing is separately identified asset. So we will separately identify the vehicle that has suffered that goodwill. 2. Also on 1st February, a rival taxi business commenced business in the same area. It is expected that the revenue of AB will decline, leading to a fall in value of the usage of the business, which is calculated at $140,000. It is unlikely that the business will be sold as a going concern. What is the meaning of the second statement? What's the meaning of the second statement? It means right now, the carrying value of the business is what? $140,000. So that is the value of the business now. Because of the rival business, now the value of the business is $140,000. The net selling value of the taxi license has fallen to $25,000 as a result of the rival taxi operator. Required. Describe how AB Limited would treat the above in its financial statements. So how do we go about answering this question? There's a pro forma presentation that we have to go for, and that is what you have to take notes all the time. Number 1 is to talk about the carrying value. Now, this is a business, so you are dealing with a cash generating unit. So we will look at the carrying value before impairment, and we will put impairment in the middle, and we will look at the recoverable amount at this side. That is all the carrying value after impairment. Are you working in thousands apps or just dollars? So let's look at the carrying value. The carrying value will be the list of the things given. So give me the list of the things given. Garage, 20 million, computers, 10, vehicles, 90, intangibles, 30, receivables, 10, cash, 50, payables, 20. And that gives us
190.
A liar has a tail because we bought the business for how much? 230. So there has to be what? Goodwill somewhere. So the balancing figure I told you will be called what? Goodwill. So we paid 230 here. So what is the balancing figure? 40. Are you getting the idea? So this is very important. So now, what is the value of the business from the note 2? 140,000. So 140. So when we subtract, what is the total impairment? Subtract this from this. That will give us the total impairment. 90. So that is the total impairment. How do we allocate this total impairment? I told you step 1. Allocate to what? Separately identified assets. What were the assets that were separately identified as impaired? 3 vehicles, which each was 10,000. So the 3 will give us 30. Then we are told of the license of the company that it is now valued at what? Do you remember that?
Yeah.
That is note 3. Now it is valued at what? 25,000. So that is the recoverable amount. 25. So it means it has suffered impairment by 5 million. Do you understand? So these are the separately identified assets. Then we said, when we finish, what do? Write off goodwill. 90 minus 35, what do we have? 90 minus 35, 55. So goodwill is 40, isn't it? So we can write off all the goodwill. So the whole goodwill, bye-bye, nothing will be there. Then the third step is that you allocate the goodwill to the remaining assets on pro rata basis. But listen carefully. Cash doesn't suffer impairment. So your cash is your cash. The same figure will be there, 50. Then receivables will not also suffer impairment. The same figure will be there. Then your payables doesn't suffer impairment. The same figure will be there. So what do we have? Computer and then the garages. Since you are carrying, how much are we left with?
15.
15. So that 15 will be shared among what? Or between garages and computers. So when we add the 2, it will be what? 30. So that will be 20 over 30 times 15. Then this will be 10 over 30 times 15. What we got? 5, 8. 10 or how? Not 5, remember. Into we are 10. Now we are 5. Now we are 60. Add all and let's see if you get 140. Do the arithmetic here. You got that?
Yes.
That's it. So this is how we allocate impairment. So remember the 3 steps I gave you. 1, allocate to separately identified impaired assets. 2, write off goodwill. And 3, allocate the goodwill to the remaining assets in proportion of what they have. But remember, receivables will always be the same. Your cash will not suffer impairment. Your payables may not suffer any impairment. So those ones, the same figure will be there. So it's only the non-current assets that suffers impairment. This is what you have to understand about IAS 36 and 38. What did they say we should do, Angaza?
Describe how A and B treats it in the financial statement.
We treat the above in the financial statement. Okay. So now, I won't do that, but you will do it. Now when we go to the balance sheet, this will now be the values of the assets respectively. Are you getting it? Then in the income statement of income statement. So in the income statement for the year, the only thing that will come here is what? The impairment, which is the total of 90 million, period. But in our statement of financial position, we're going to be bringing the non-current assets. And under non-current assets, we will bring garages. Remember, the goodwill is no more. We will bring computers. We will bring vehicles. We will bring intangibles. So, 2 cash columns. So garages, the recoverable amount or the carrying value after impairment. So garages is now 10. Computers 5. Vehicles 60. Then the intangibles 25. Please add these 3 for me. Sorry, these 4. Then we come to current assets. That will be receivables. Receivables is still 10. Then cash. Cash of 50. That will be 60. What do I have here? 100. Okay, that will be okay, 100. So we add this to this. 160. And that is the total assets. Then we bring the liability. So it follows. So liabilities. And under that we have only current liability, and that is the payables. And that is $20. So this is how the statement of financial position will now be prepared for the company.
Please, if those separated those are not identified, how will you share the
assuming none of the things were identified, then we write off goodwill straight. So you just follow that hierarchy I gave. So you write off goodwill. Then the 50 that will be left, you would have shared it among the 4 on the pro rata basis.